Bond yields are rising. Equities and cryptos are making new all-time highs, and despite excessive money printing, gold and silver are still languishing and struggling to get out of the starting blocks. My guest this week on Gold Core TV is David Brady of Global Pro Traders, and he says that when it comes to looking at financial markets going forward, using his personal trading methodology, FIPESTxM, when it comes to gold and silver, it's a case of the Tinas. There is no alternative. And if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to Gold Core TV and hit the notification bell now. David Brady, welcome to Gold Core TV.
Oh, thanks, Dave. It's great to talk to a fellow Irishman for a change.
Likewise. And you're on the line from Canada. So first of all, I have to ask you about FIPESTxM. What is FIPESTxM?
FIPESTxM is my process that I've developed over several years, and I'll get into the details of it straight away. FIPEST, F stands for fundamentals. And when I talk about fundamentals, I'm not talking about corporate earnings or GDP. I'm talking about the fundamentals that matter to the market these days, which is basically liquidity. Liquidity drives all markets, and by derivation, what the governments are doing from a fiscal stimulus perspective, and on top of that, what the Fed and the global central banks are doing also. Intermarket analysis, which is the I, refers to other markets that have an influence on gold and silver, and we know this by just looking at charts going back to going back 15 to 20 years. And in this case, one of the most pertinent is the nominal yields and real yields, more importantly, more specifically. And those would be the 10-year and the 30-year, depending on your preference.
We just explain, just for a moment, maybe to our listeners,
yes,
the difference between the real and nominal yields.
Sure. Nominal yields are the yields that you see quoted on the markets for, say, the 10-year and the 30-year that are like, I think the 30 years around 2.3, 2.4%, and the 10 years in and around 1.5%. The real yield is that yield less inflation. And so if inflation is currently around 2%, and you've got a 10-year yield of 1.5%, your real yield, simple math, it's more complicated than this, but simply put, you get close enough. It's 1.5 minus 2% gives you a negative real yield of minus 0.5.
Okay.
Yeah, just one other comment on the I. The reason why real yields are so important is if you go back and look at charts of, just chart the real yields relative to gold and silver. And you'll see, in March of 2020, when gold and silver bottomed, silver around $11 US, and gold, I think it was around 1167. And actually, sorry, it's a little higher than that. But when they bottomed back then, real yields had peaked. And then you can look again, go forward to August, when real yields bottomed and nominal yields in particular bottomed, and they started to go up. In terms of real yields, they went up slightly sideways to up. Nominal yields went up dramatically, as we've seen recently. Well, what's happened to gold and silver since then? They've gone south. So there's an inverse relationship between nominal and specifically real yields and gold and silver. And this makes sense that one has a great degree of influence on the other, because the bond market is dramatically bigger than the gold and silver market. I mean, many times bigger. So the dog is wagging the tail. The only market that's bigger than the bond market is the currency market. So just keep that in mind. So switching to P refers to positioning. And I'm also going to pull in XM here as part of the process. That means excluding manipulation. The point being that when I'm looking at all these tools, you have to consider the possibility of manipulation. Now, we can debate whether it's true or not, but the courts have already adjudicated on this. And to me, as a trader, a seasoned trader, it's obvious. So what do I mean by, why do I want to put them together? Because positioning of the bullion banks is typically to the short side in metals, which means they prefer that the prices go down. And what happens often when they get to extremes in their shorts, you see peaks in gold and silver. Now, fortunately, it's in the short term. Manipulation can go on for some time, but it comes about in spurts. And the manipulation happens for a period of time. It could be just a day, it could be a few days, it could be weeks. But then it ends, and then gold and silver resolve to their fair value. And the point being that if you watch the positioning on the CME, Chicago Mercantile Exchange, it will tell you what the positioning of the banks is. And you can go back and look at the peaks and troughs in gold and look at the peaks and troughs in the bank's positioning. And when the banks are very short, gold tends to peak. When the banks are long or neutral, it tends to bottom. So that's another factor that I monitor to gauge which direction is gold and silver going in. I'll move to E, and I won't go into too much detail on this, but Elliott wave analysis is a very extremely valuable tool in determining where metals and all markets are going, not just in the short term, but the long term. But the use of Fibonacci levels in the very short term can be extremely valuable in concert with traditional technical analysis, where you're looking for support levels or resistance levels from which, gold and silver or any other market are going to bottom or going to top. So that's how I use Fibonacci levels in my analysis. And lastly, technicals. Well, technicals are the things that most people know about. It's looking at the charts and looking at moving averages, trend lines, resistance and support levels, indicators, momentum indicators like the RSI, the Relative Strength Index, and the MACD. And the reason why I like those indicators, specifically the RSI and the MACD, is they will tell you when a market is extreme overbought or oversold. Well, it's basically intuitive that if a market is extremely oversold, there's a high likelihood that it's going to go in the opposite direction, up. And the same if it's extremely overbought. And I'll finish with the S, which is most pertinent to gold and silver because it's, the precious metals market is a very emotional space. So I tend to get into trouble with a lot of people on Twitter for my calls, but whenever I see everyone becoming extremely euphoric, i.e. bullish in gold and silver, such as when we were going up to 1900s to 2000s back in July, August, I start looking in the other direction. And the same when everyone is bearish and throwing in the towel, as we saw in March of 2020, I get very bullish. So, and that has served me well for many years. But the beauty of this process, Dave, is at the end of the day, and it's been time tested, I developed it by looking at the peaks and troughs in gold and silver, but across all markets, to nat gas, to oil, cotton, you name it. And I looked at what those various tools were telling me at each of those peaks, and I looked for patterns. And the beauty of that is when you go back and look at 20, 30, 40 troughs and peaks in these various markets, and you look at each of those indicators, which all have validity. There are some people that are purists on the technical side, purists with regard to Elliott wave analysis, purists with regard to fundamentals. My 2 cents on that is, why limit yourself to one tool when they obviously all have some degree of credibility because many people are using each one? So why not avail of all of them? And the beauty of that process is if you do identify the consistent patterns at each peak and trough in the past, what you do is look for those same patterns in the future. And when all of these tools point in the same direction, it gives you a greater degree of confidence that you're going to be right with regard to your trade or investment. Now, it's not 100% guaranteed, but the probability of being correct increases dramatically. And the other beautiful thing about it is the worst thing you can do, the destruction of a portfolio, is primarily attributable to emotion. People get emotional about their trades or their investments, and this is where loss aversion comes in. When you buy something and it goes down in price, people will hold on expecting or hoping that it goes back up. And by contrast, when they bought and it's going higher, do they take profits? No, because they think it's going to keep going higher. And that's where that's fear and greed playing, coming into play. Well, the beauty of having a process that you develop yourself, develop your own, you don't have to use mine. The beauty of such a simple process is that it enables you to be objective with regard to your trades and investments.
Brings discipline into the process.
Exactly. And this is why I get into trouble on Twitter sometimes. When back in July of last year, I did a podcast and I said, we're going to get a massive pullback that will provide the greatest buying opportunity for gold and silver for many, many years, perhaps ever. And the amount of the negative response that I got to that was overwhelming. Well, here we are.
It's like calling it an ugly baby.
Exactly. Nobody wants to hear it.
No.
But the beautiful thing about that for me is when I get that response, that typically tells me I'm right. Because everybody is so euphoric and so blinded by the market, the price action, that they can't step back and go, wait, hold on. We're up nearly $1,000 from the low of 1167. Maybe, we're due some kind of pullback. No, they're delusional. They just keep going, it's going higher, Same with Bitcoin in 2017. When it was going parabolic, I came out and said, the futures, there's 3 futures markets opening up in Bitcoin in the next few weeks. So buyers meet sellers.
Yes.
You got the banks coming in. And what happened? It collapsed.
We might get on to touch on Bitcoin in a bit, but I want to ask you just if you take your process then and you apply it to what you're seeing today.
Yes.
What is your process telling you at this moment in time?
It's telling me that we've seen the bottom, or more likely we're close to the bottom. We've got one more low to go. And I'll quickly go through the various reasons for that.
When you say that, you mean in gold?
In gold and silver. Silver's got further downside, I believe, because if you look at the gold-silver ratio, we had a massive move down from a peak of around 120, and we've fallen to close to 60. I mean, that's a 50% drop. So I expect a bounce in gold, the gold-silver ratio. So what that means in real terms is gold is likely to lead the way up, as it often does in rallies, and then silver has to play catch-up after the fact, but then blows past gold. And so I do believe gold is going to bottom first, and then silver may have some further downside and will follow thereafter. That's my thesis there. With regard to the various, my process and how it applies today, if you look at the fundamentals, you've got the IMF came out in January and told governments around the world to spend. You got Biden just got his 1.9 trillion passed, and he's already talking about doing more. You got Powell came out at the recent FOMC and say they will do whatever it takes to support the economy, etc. And then you got Yellen basically hinting at MMT, where the Treasury and the Fed work together hand in hand to support the economy. All of that is inflationary, by the way. But the reason why that's so important is I called the bottom in March of 2020 simply by looking at what the Fed had done. They tapered their intervention into the repo market, which by derivation means stocks, on February 19th, and markets dumped.
Yeah.
You knew that they were going to step in. Well, I did, and they did. They spent $3 trillion supporting the fiscal stimulus on the government's end. And what happened to gold and silver? It bottomed on March 16th and shot higher. And then fast forward to July, and this was the reason for my call around the peak then, 3 weeks ahead of the peak on August 7th. The Fed was announced in July that it was tapering its monetary stimulus by 75%. At the same time, the emergency benefits to the unemployed in the US were due for, they were up for extension. And everybody thought they would be extended given the state of the economy. I raised the risk that they are allowed to expire. And what happened in August? They expired. So between July and August, you had the Fed / monetary stimulus, the government / fiscal stimulus. And what happened to gold and silver? They went south. So is it a stretch to believe that when the Fed comes in and caps yields, yield curve control, which I'll get into in a second, when they start printing money again to pay for all the debt that's been issued to finance new government spending by Biden and his administration, that gold and silver is going to go higher once that happens? To me, it's obvious. So switching to yield curve control, which is the I, bonds, I follow the 30-year because if you look at a 100-month moving average in the 30-year, it has been tested numerous times over the past 30 years. So it's a very reliable indicator, to the point where in September of 2018, we were going north of 3% on the 30-year, which was approaching the 100-month moving average. I said, we're going to sub 2%, 1% from here. If it goes to the moving average or even goes slightly above it, buy bonds. Well, the rest is history. The bond yields collapsed. And here we are in the opposite direction. We've bounced from the lows. Now we're back up, moving back towards that moving average. And I believe the same thing is going to happen again. The Fed, or whether it happens naturally or through Fed intervention, by capping yields, buying the debt to keep yields low, that when that happens, you're going to see yields either stay where they are, around 2.5% to 3% on the 30-year, 1.5% or below on the 10-year, or go down. And if that happens at the same time, you're seeing inflation go up as the government spend hand over fist, the Fed and other global central banks print money to pay for all the new debt. And at the same time, you're getting lockdowns around the world. We've already seen many bankruptcies in the small and medium-sized businesses everywhere. You've got more money chasing fewer goods and services. Well, that's the basic definition of inflation. So when you've got nominal yields capped or falling, at the same time inflation is going up. Going back to that equation earlier that I mentioned, real yields are nominal yields capped or falling minus inflation, flat or much more likely going up. There's an asymmetric risk to the downside in real yields. And historically speaking, yeah, you get short-term breakdowns in the correlation. But over the long term, they are near perfectly inversely correlated, which means that if real yields do go down and go down to lower lows, gold and silver are going to explode higher.
Now we're seeing, obviously, we're starting to see inflation ticking up. We're seeing commodity prices rising. It's starting to come through to the shops and to the consumer. It's not necessarily being officially spoken about, not to the degree that it's actually hitting the pocket of everybody. But as we see higher inflation, this obviously makes bonds less attractive. Hence, we're going to see a sell-off in bonds. Does that mean that it's more likely in terms of getting a yield curve control that it is going to be Fed intervention or central bank intervention?
Yes, exactly. I mean, there's I'm not a big fan of many bank analysts, but there is one at Bank of America, Michael Hartnett, and he came out there a couple of days ago and said, yield curve control is inevitable for the very reasons you just mentioned. And why is that? Look, they can't allow yields to go dramatically higher for one simple reason: the debt. The debt is massive. The debt is increasing. It could increase dramatically. If the yield on that debt goes up at the same time as the debt is going up, the interest cost soars. And if the interest cost soars to a point where they're paying more in interest on the debt than they're taking in tax receipts on an annual basis.
Basically bankrupt.
That's the definition of insolvency.
Yeah.
I mean, you can do it at the personal level or the government level. I mean, if you can't even pay the minimum credit balance payment on your credit card, and you have to borrow to pay it, you're insolvent. You're bankrupt. So it's the same at the government level.
And
go ahead.
If they do bring in yield curve control, this year or whenever,
Yeah.
Very difficult to reverse that in the future, isn't it?
Well, look at Japan. They've been doing it for years. No, you can't. If they stop, and that ultimately is what leads to the greatest depression, in my opinion, is that the risk we run with all this money printing and government stimulus, which is only getting started, as we can tell from the IMF, where they said in January, governments need to spend, and then spend some more. That's basically a license to just, print money ad infinitum, so inflation is going to take off. Well, if yields are allowed to take off too, well, then everything collapses because the cost of borrowing will shoot through the roof. So they can't allow it. And you're right. If they once they start, they can't stop, because if they stop, then reality hits and yields go dramatically higher, and it's game over for stocks and everything else.
Does that mean that there's only one real purchaser of US bonds, though, going forward, as in the Fed? Because I mean, if you've got inflation going higher and you've got yields capped, it doesn't make US Treasuries very attractive internationally, does it?
No, I mean, if you there was a couple of analysts like of Luke Groman who talked about this. I had the same opinion, but I didn't put it in such eloquent terms as he did, which is the trilemma, the Fed's trilemma. The Fed has an official mandate, but its unofficial mandate is to support stocks, to cap yields, and to support the dollar. Now, there'll come a point, and this is going back to 2017 that we were both sharing this information. There'll come a point where they have to choose 2 out of 3. You can't have all 3. So if you want to support stocks, you have to print money and buy, however, we can get into a debate how that happens, but the money filters through the stock market and it goes higher. You just have to look at a chart every time the Fed prints and what happens to the stock market. And when they taper it, what happens to the stock market, as on Feb 19 last year. Bond yields. When it comes to bond yields, if you cap bond yields and you're supporting stocks through money printing and paying for government stimulus in the process, what happens to the dollar? That's the sacrificial lamb. And we've already seen that since March 2020. The dollar has fallen over 10% against the euro and the other currencies. And look what's happened to gold and silver at the same time. They've gone up $1,000 in gold. Yes, if they cap yields, they can't stop. They have to. They'll keep doing it until my 2 cents have been saying for quite some time is the end game is that we get hyper-stagflation. What I mean by that is you get hyperinflation in prices, and arguably we're seeing the nascence of that in food prices right now, and in lumber prices, and one could say gold. Stagflation, the stag part reflects the fact that the economy is bleeding. You're seeing businesses, small and medium-sized businesses, which are responsible for 50% of employment, or more, some would say, and they're going out of business by the day. So the economy is suffering at the same time inflation's going up. We saw this in the 70s. You get stagflation. Well, I am talking about hyper-stagflation. When we reach potentially a Weimar moment where the Fed's printing money to pay for government stimulus, and all confidence is lost in the currency, then the only thing that's left for the Fed to do is to pull the plug, just as the Reichsbank did back in the 1920s. And what happened at that point? You had, depression. And that's what I see as the trigger for the greatest depression coming soon, because we have the greatest bubble in history across all markets, except maybe precious metals, which is why they're so undervalued. And that's why, I call them the TINA. There is no alternative.
And okay, well, touch on that for a second, because obviously over the last year in particular, maybe last 2 years, 18 months, with all the printing that has been going on, we've seen a massive rally, fairly much one-way direction in stocks. So we're seeing money just plowing into the stock market. Right. We're seeing the same in cryptos as well. Yep. Okay. And it has been fairly much, apart from a few pullbacks in Bitcoin, for example, it's been fairly much one direction. Yeah. We're not seeing that as much in precious metals. My first question is, why is that? And what changes, in your view, that will send gold and silver much higher? Or do they all go higher together, stocks, cryptos, and precious metals?
Okay, my answer to this question, Dave, is this is just my opinion. I'll qualify that at the outset, because we're getting into a territory where some people will call this conspiracy thesis. To me, the evidence is very much to the contrary. I would argue with Bitcoin going dramatically higher and gold and silver, it's going higher, it's going to and fro, it has a nice move up and then a pullback, and which is what we're undergoing now. Which one do you think if these markets are all centrally managed and gold and silver are struggling since August while Bitcoin is blasting higher, which one do you think they fear most? It's obvious, it's precious metals. And the reason for that is through history, and certainly modern history, gold in particular is considered the anti-dollar. Alan Greenspan basically said so, Volcker too. Meaning that if gold goes dramatically higher, that's a reflection of that all confidence has been lost in the dollar. So that's the reason why they want to keep it down. Because once the dollar crashes, you need a great reset, which apparently we're getting anyway. But until that occurs, they don't want to lose control of the system. So there's a motive to keep precious metals down, in my opinion. Whereas Bitcoin, which has taken off and is doing extremely well, I'm happy for all of those who got in early and are making money on this. But the problem I see is that the central banks of the world that are centrally managing markets these days, they have total control over the global money supply. Global transactions. Do you honestly believe that they're going to allow competition from a private enterprise such as Bitcoin to basically undermine their total control of the system? I don't believe so. So why is Bitcoin soaring higher? Well, they're all pursuing central bank digital currencies. And one of the benefits of Bitcoin and other cryptos like Ethereum and so forth doing well is it makes digital money popular in the mainstream consciousness. In other words, when they roll out their central bank digital currencies, they'll be readily acceptable. We're used to cryptos. Now we get to central bank digital currencies. But how long do you think after those central bank digital currencies come into fruition, they're going to allow Bitcoin to continue to operate as is? And when people say, they can't do anything about it, it's private and so forth, well, I'll give you a couple of things. What if they make Bitcoin illegal for use by any corporation in the world in terms of payment? In other words, if you want to buy something on Amazon, you can't use Bitcoin to do it. At the same time, their tax authorities tax every single transaction at a capital gains of tax rate of 90%. I'm just using worst case scenarios. Yeah. They have the means. Now, I hope I'm wrong. I've said this since day one. I hope I'm wrong, but there's several people such as Danielle DiMartino, a former member of the Dallas Federal Reserve, who said this back in 2017. This very point. The central banks have total control of money in the world, and that's what gives them their power. You think they're going to cede that power to Bitcoin and the cryptocurrency community? No way. And the risk that they run is this goes up to, I've said recently, Bitcoin could go 100,000, 150,000, maybe even 200,000 in dollar terms, maybe more. But the risk you run is similar to 1929 and the Mississippi bubble and every other parabolic rise in the market, is that ultimately it goes to zero. They crush it. And I hope I'm wrong, but that's the risk. But going back to your original question, why are metals not doing as well as Bitcoin? Because Bitcoin serves a purpose for the central banks. It's making digital currencies widely acceptable. Gold and silver are the anti-dollar. If gold goes dramatically higher, confidence is lost in currencies, and they're not ready for that yet.
And does there come a point in time then when central banks either decide or can no longer afford to keep the price of metals down?
Oh, absolutely. I mean, manipulation has an expiration date. The prices of gold and silver were suppressed back in the 90s. And we have official confirmation of this, from the likes of the former Bank of England Governor George, and the brown bottom in gold back in 1999 when the UK government sold all their gold to help out trading houses, otherwise known as the big bullion banks today, from going bankrupt. What happened next? You saw a dramatic rise in gold and silver prices from 2000 to 2011. Go back to the 1970s. You saw between 1974 to 1980, and most of the gains in 1980 alone, you saw gold go up 24x and silver go up 36x. So, and this was after the failure of the London gold pool in the late 1960s. So, suppression of gold and silver can go on for quite some time and successfully, but eventually it reverts to its fair value. It catches up to the money supply. And we're seeing signs of that now. The COMEX almost went broke back in March of 2020. They had to go to London to source physical metal given all the delivery demands they had. And now you're seeing, and premiums blew out back then. Well, now you're seeing premiums blow out yet again. What do I mean by premiums blow out? If you go out to try and buy the physical metal, either a coin or a bar today in gold and silver, the price you pay for it is dramatically higher than the figure you see on the future screen. When it shows like silver at 25, I mean, recently the silver future was showing $28, and the price for a silver maple leaf coin was at $50 if you wanted to actually buy the physical metal. That shows a breakdown between the two. Well, what's the cause? Well, the bullion banks are short. They don't want to get run over and suffer billions in losses and potentially bankruptcy. So they have obviously an incentive to keep the prices down. Meanwhile, in the real world, it's extraordinarily difficult to get the physical metal, and prices have gone dramatically higher as a result. You could see the divergence between those two prices contract again, especially as we head down to a lower low here. Maybe the bottom is in, but we could hit a lower low. But I believe it's just going to get dramatically worse, or paper prices have to catch up dramatically to physical prices. And so to answer your question, the positioning of the banks, they were extremely short. They're much, much closer to neutral. When they are neutral or long, as I said earlier in our call, watch gold and silver start to go up. And so once they're on side, it reminds me in The Big Short when Michael Burry was betting on CDS's credit default swaps against the housing market. And then initially, even though the housing market was blowing up left, right, and center, his holdings were still underwater. Then all of a sudden, they didn't say who, but let's say, hypothetically that it was Goldman or Morgan Stanley. Once they had got on the right side of that CDS market, what happened to those CDSs?
All hell broke loose.
Yeah, they soared.
Yeah.
So it's the same thing here. And that's what I think is going to happen going forward. And it's going to be impossible to deny if we do get yield curve control, when they do cap yields, and at the same time, you're seeing inflation soar across the world, specifically in the US too. Where does the inflation come from? In necessities, the stuff people need. Like, forget about Gucci belts, as I like to use that as, nobody's buying those. They're down 30 to 50%. That's why I get a little dismayed by this debate over whether it's inflation or deflation. It's both. It's deflation in the stuff that people want but don't necessarily need, and it's inflation in the things that everyone needs. And you just have to look at, as you said, commodity prices, cotton, soybeans, sugar. You go to the grocery store, look at meat prices, look at lumber prices, housing prices,
oil. Oil, you can see it going up at the pump, and that's where it hits. That's where it hits you fast.
That's why I sent out that tweet yesterday, where I've been tracking my grocery bills since March 2020, and it's obvious to me that inflation's taking off. But we get a CPI printing 1%, 2%. I mean, it's ludicrous. But that's the goal. They want to, once inflation is out, the genie is out of the bag. Then we're heading to the end game of hyper-stagflation, and where the Fed is forced to pull the plug ultimately. And at that point, gold and silver are in the stratosphere.
Talk to me for a moment about the velocity of money. Maybe you might just explain exactly what that is, because we're seeing the velocity of money has slowed significantly of late.
Well, first of all, it's just a variable in an equation to justify or to determine the inflation rate, GDP divided by money supply. And I have a problem with, it serves, it does its job in explaining why inflation is at 1% to 2%. Is it reality? Not based on what I'm seeing on the ground and other people around the world too. And specifically what it relates to supposedly is the amount of money circulating in the economy. How often is $1 spent by each and every person? So the velocity, the speed at which it's being used. But I prefer a much simpler measure of inflation, which is if you've got massive money printing on one side, and yes, it has to go into circulation. One of the reasons we didn't see inflation after all the money printed back in 2007, 2008, and 2009 with all the QEs was because it went onto the Fed's balance sheet as bank reserves. But as soon as it seeps into the economy, which it always does, we saw this back in the 1960s and 1970s, all the money printed for the wars and so forth in the 1960s, ultimately it played out in the 1970s when we got stagflation, dramatic inflation in the US, when Volcker had to increase rates to 15 to 20% to avoid the collapse of the dollar. You're seeing money printing on steroids. You're seeing stimulus on steroids from the government in terms of fiscal stimulus, not just in the US, around the world. At the same time, you're seeing the lockdowns in response to COVID-19 causing bankruptcies in smaller and medium-sized businesses everywhere, and a massive increase in unemployment and so forth. So you're getting more and more money chasing fewer goods and services. And it's only beginning, as I mentioned, based on what the IMF has recently stated. And, the 1.9 trillion from Biden, which he said he's going to continue to add to that in the near future, probably even more so. This money printing is only getting started. And can you imagine what it's going to be like if we get universal basic income? So everybody's sitting on their couch watching Netflix 24/7, has a check coming through the door, can go down to the grocery store and spend their check. They're not producing anything. They're not providing a service. They're just getting free money, and they go and spend it. So you got more money chasing fewer goods and services. That's the definition of inflation for me. It's as simple as that. There's a greater supply of money, and there's a less supply of goods and services. Economics 101 just tells you that price has to go up, and we're already seeing it. This is the thing. This is not an opinion. If you, as I said, I've been tracking my grocery bill since March 2020. Carrots have gone up 17%, cucumbers 33%, eggs 4%, waffles 10%. And I'm looking at the same brand from the same period a year ago. So there's no seasonal factors. It's exactly the same brand.
Like for like.
Yes. And I've got a list of like 150 items. And it's obvious.
So the official inflation number is sub 2%. So what are you reckoning that the real inflation figure is?
It depends. But if you would take the shadow stats number, which is based on the 1980 definition of inflation. In other words, they calculated it differently back in 1980, and then they changed it to include hedonic adjustments and so forth. But if you look at shadow stats number, it's around 8 to 10%. And again, one of the main reasons you asked me, what's my process saying? If you look at the fundamentals, money printing, government stimulus, intermarket analysis, bond yields can't go much higher, so they will have to be capped at some point, as Michael Hartnett of B of A has said himself. You look at positioning, the banks are closer to neutral. You look at sentiment, which has gone from extraordinarily bullish when we were at new record highs in gold. Now people are throwing in the towel. And you look at the technical analysis, you've got relative strength indicators and MACDs at levels that are below the March 20 low levels. Some going back to December 2016, when we were at 1124 in gold. Everything is pointing up. Everything is pointing to a turn here shortly. It's only a matter of time. I like to put it this way. When I look at markets, you look at risk reward. And I'll use gold as an example. Gold could fall, anything is possible, but gold could fall realistically another $50 to $1,650, maybe $1,600, maybe even $1,500. But once it finds its bottom, we've already come down from 2089. Once it finds its bottom, the risk is that we go north of 2089 to 2100, maybe 2200, maybe 2300 before we get our next pullback. So you're comparing a risk of 50 to 100, maybe $200 to upside of $400 to $600. So, and that's just the short term. I'm talking months. Years out. We've got forecasters, very credible analysts out there providing forecasts for gold and silver based on math, not based on their opinion. Just looking at the money supply and the increase in that money supply over the past 2 decades, and the increase in the debt and where those numbers are going forward, and just estimate what gold could go to catch up to that increase in money supply. And we're talking like 8,000 gold, 10,000 gold, 25,000 gold, 50,000 gold. And given that silver always outperforms gold in bull markets, and the reason for that, it's the poor man's gold. When people wake up to this, they go down to their bank and they go in with their $2,000 and say, "Hey, I want to buy some gold." And the person behind the counter just smiles and says, "Sorry, that won't even buy you one coin." Well, what can I buy? Oh, well, you can get 40 ounces of silver. Oh, I'll take that.
I love that.
Yes. Yeah. If you look at what happened to silver and then from 1974 to 1980 relative to gold, silver went up 36 times, gold went up 24 times. Same thing happened from 2000 to 2011. Gold went up 8x, silver went up 12x. There's no reason to not expect that to happen again this time around, perhaps even more so, because silver is so dramatically undervalued. And I think that's where this is all going, Dave. It's only a matter of time. And the bottom, as I've said, I believe it could be in place already, but I think we've got one more dip to go, but it's close. And then we're going to have a nice rally on the upside, because the fuel for it is there in stimulus, printing, sentiment, positioning, technical indicators. It's extreme oversold, extreme bearish, all of the things that you want at the lows.
Brilliant insight, David. Obviously, you're a huge fan of gold and silver, but is there anything else that you recommend?
Oh, absolutely. As people like to say to me all the time on Twitter, is you can't eat gold and silver. True, but I can certainly buy something with it. The Mennonites here up in northern Canada will take silver every day and twice on Sunday for a dozen eggs and so forth. that aside, it gets to my point. Food is number one. I mean, that I hope we don't get the supply shocks that we're seeing. You see it in lumber, you've seen it in meat, you saw it in gold back starting in March 2020. That they don't filter through to food, because we're already seeing food prices increase. With all the increase in money supply, and that's going to seep into circulation. And if we do get universal basic income, in Canada, there's a bill being debated in Parliament on that very topic. If we do get universal basic income, at the same time, supply chains in the food sector start to break down. I mean, I don't want to go where that could end. Mass starvation. Food, and let me take a big step back here. People need to store some food, given the state of the world today. And I would argue that there is no downside to doing so, because even if everything turns out to be peachy going forward, inflation is still going to be positive. So even if you buy it and the world doesn't break down and there isn't mass starvation, the cost of the food that you bought will be lower than it is 6 months, a year, 2 years from now. So there's no downside to doing so. So to answer your question, food, energy, I'm a strong believer in self-sufficiency, because the prices of everything you mentioned earlier, energy, electricity, everything's going to go up, in my opinion. So if you can add some solar or diversify your energy sources, if you've got trees around your property, if you potentially have wood, propane, natural gas, the grid, of course, solar, wind. Just diversify your energy sources so you're not reliant on the grid, and you have alternative means to boil your eggs when you need to. Shelter is an obvious one, and security, and I would say community. Like-minded people, because we all need to look out for one another if times get really bad. We can all create our own little kingdoms and protect our little fiefdom, but having friends and neighbors all looking out for one another would be a huge benefit, because you're never going to know when you're going to need your next door neighbor's help. So I would say food, shelter, energy, water, obviously, and security. And I just got ordered 2 German Shepherds, for example, and community of like-minded people. So that's my recommendation. And the pushback I get a lot is, especially from people in the city, is, oh, well, you're well-heeled, David. You can afford that. I can't. Look, I sold my property in the GTA for close to $2 million. I bought this property 2-3 hours away from the city, 5 acres, small farm, dilapidated. Cost me $280,000.
Wow.
And it cost me $85,000 to gut the property and renovate it completely. So, when I'm out, close to $400,000.
Yeah.
It's now worth well over $1 million now. And my point is, if you're living in a condo in Toronto, New York, London, Dublin, you can't tell me that you can sell that with what house prices have been doing, especially in the past 12 months, that you can't sell that property and buy a small spot out in the country and still have money left over.
Have you any parting thoughts before we wrap this up?
The key takeaway with regard to the markets is try and learn to put your emotions aside. And we went through my process in detail, but I recommend develop your own process. The way I develop mine is, and it takes time, but it can be a lot of fun actually, is because you get aha moments when you do this. Go back and look at the peaks and troughs in gold and silver or natural gas or stocks or oil or the dollar, et cetera, and look at the various factors, fundamentals, intermarket analysis, positioning of the banks, the funds, the small speculators, the other representatives, sentiment, the technicals, At each of those points, just go through it, pick one and go through it at each peak and trough. Do this yourself, and you will see consistent patterns. Now, they won't always be identical. Like you will get an extreme blow off top in RSI, for example, or you could get a negatively divergent higher high in price, and a lower RSI, which means that the price has gone to a higher level, but the RSI has gone to a lower level relative to the previous peak in the RSI. And it could be one or the other, but I don't want to go down that rabbit hole. But the point is, you will see consistencies, patterns. And once you identify those, you can extrapolate those forward. And by using multiple tools, when all of those tools say the same thing, you can have a high degree of confidence that this is going up. My case in point for me was in the second half of 2015. Everyone was bearish gold and silver, to the point where they weren't even bearish. They didn't care. There was complete and utter apathy. Gold, silver, what's that? People still thought, does that still exist? Could I still buy that? I mean, it wasn't that they hated it. They just didn't care. And that to me was a sign, amongst many other factors, that they were going up. But the key aspect of this, and it's not 100% guaranteed, but it does increase your confidence in your trades. But the key aspect of this is it takes emotion out of the situation. I see some of the best analysts out there, and they provide great information, but at each peak they're uber bullish, and at each trough they're uber bearish, like everyone else. Emotion is the death of any portfolio. If you can screen that out, you're halfway there. You're halfway to success in managing your money. And that's the key takeaway I would give people. Sentiment is a portfolio killer if you go with the flow. The only caveat to that is when you get a strong trend, don't fight it. And that's why I believe that, none of these rules are, 100% guaranteed, but the majority of the time they work. And I recommend people just do the analysis themselves, and they'll see it. The bulb will go off. And, this isn't rocket science. Anyone can do this.
Now, you referred to tweets that you've sent out recently. If people want to follow you on Twitter, what's your Twitter handle?
At Global Pro Trader. At Global Pro Trader. You'll find me there. I've got a great following of people, and I welcome the more the merrier.
Super. Listen, we'd be delighted to talk to you again, Dave. Really appreciate today and sharing with us your process and everything else that we've spoken about. So thank you very much for joining us on Goldcore TV today. Thanks for watching. And if you want to see more interviews with thought leaders and industry experts in financial markets, subscribe to Goldcore TV and hit the notification bell now. And if you enjoyed this video, check out this interview that I did with legendary investor and adventure capitalist Jim Rogers, where Jim issues a warning about the effects of excessive money printing and the effect that it's having on asset price inflation. Go watch that video next.